The biggest risk to the United States economy has never been the AI bubble. It hasn't been China, and it certainly wasn't the orange man in the Oval Office. It is something far more mundane, something you likely haven't heard of unless you've descended deep into the financial rabbit hole. And that is exactly why no one is paying attention. If you've been wondering why mortgage rates refuse to retreat, why equity markets intermittently succumb to sudden bouts of volatility, and why the Federal Reserve can signal rate cuts while financial conditions remain stubbornly tight, the answer does not originate in Washington. It begins in Tokyo, specifically within the most boring asset class on Earth, Japanese government bonds, JGBs. The silent duct tape of global finance. For 30 years, Japan has been the silent duct tape holding the global financial system together. To understand why, one must rewind to the early 1990s. In 1992, Japan's massive asset bubble burst, real estate collapsed, equities followed, and the nation entered what became known as the lost decades, a 30-year period of financial stagnation characterized by zero growth, zero inflation, and stagnant wages. It was as if the economy hit the pause button and the remote control was nowhere to be found. In response, the Bank of Japan resorted to the most extreme measures available. They slashed interest rates to zero and then into negative territory. When that proved insufficient, they introduced yield curve control. In essence, the Japanese government superglued interest rates to the floor. Consequently, Japanese institutional investors, pension funds, insurers, and banks found themselves with billion-dollar portfolios yielding nearly nothing at home. They were left with two choices: accept zero returns or go shopping abroad. They chose the latter, transforming Japan into the world's ATM and the planet's largest net creditor nation. The yen carry trade, global liquidity's oxygen. This capital flight wasn't driven by sentiment, but by the cold logic of mathematics. This is the core of the yen carry trade. Imagine an investor. He borrows yen at near zero interest rates, converts it into dollars, and purchases U.S. Treasuries yielding 4%. After accounting for hedging costs and fees, he pockets the spread. When the cost of borrowing is virtually zero, this capital doesn't stop at bonds. It flows into tech stocks, real estate, and emerging markets. At its peak, this trade was estimated in the trillions. For years, global markets effectively ran on Japanese Wi-Fi liquidity. But the entire edifice rested on one fragile assumption, that Japanese interest rates would stay at zero forever. When the assumption shatters. In 2024, that assumption broke. The BOJ ended its yield curve control and hiked interest rates for the first time in 17 years. The markets were immediately spooked. The S&P 500 dropped 6%, and the Nikkei 225 plummeted over 12% in a single day, its worst performance since 1987. The signal was clear. As Japanese yields rise, borrowing in yen becomes expensive, and hedging costs skyrocket. The free money trade is over, triggering a process called repatriation. The cheapest source of global liquidity for 3 decades is no longer cheap. The backbone of all markets. Japan is not just any buyer. They have been the most consistent, price-insensitive purchasers of long-term U.S. debt. While the masses overanalyze every syllable from Jerome Powell, they are staring at the wrong end of the yield curve. The Fed controls short-term rates, but the long end, 10-year, 30-year, which prices nearly every asset on Earth, is driven by supply and demand. As legendary investor Ray Dalio explained, the bond market is the backbone of all markets. It is the interest rate that determines what all asset returns are going to be. When there's a breakdown of the supply-demand picture for the bond market, you see long rates rising relative to short rates, the currency goes down, and gold goes up. The United States currently runs trillion-dollar annual deficits and must issue massive amounts of new debt to keep the lights on. If Japan, the largest foreign holder, retreats, yields must rise to attract new buyers. Thus, even if the Fed cuts the short-term funds rate, mortgage rates may stay elevated. Housing remains frozen, and equity valuations compress as the cost of capital refuses to cooperate. Traditional financial media ignores this story because it isn't as clickable as AI or political headlines. It requires patience and nuanced thinking. But the reality is that liquidity is the oxygen of the markets. When the oxygen from Japan is withdrawn, the cost of money changes everywhere, from your mortgage to the valuation of big tech. The real threats in the market never arrive with a fanfare. They are hidden in plain sight within the most boring numbers imaginable.